Shawn, thanks for joining us here on the Investment Expo.
My pleasure.
Year. You're working as a Chief Investor Officer and Head of Funds for Nuveen. Can you say what's your investment focus? Yeah.
Well, at the moment, we're definitely very focused on different types of real estate that are resilient in the current environment. For that, I think some of the most attractive opportunities exist certainly in housing across the board. And when we think about housing, you're thinking about things like middle income tenants, basically workforce housing and deeply affordable housing. But housing also includes some other great strategies like student housing and single family rentals, right? So housing is definitely one theme that we're fans of in this environment. A second one would be industrial related real estate. And I think everybody knows the rise up, the tailwinds that have been driving the success of industrial, I think continues. And then we also like alternatives, and some of the alternative real estate asset classes that we like are self-storage, right? It's pretty acyclical, and things that have sort of a healthcare theme. So medical office buildings and life sciences lab space, but also properties where you can manufacture different types of pharmaceuticals and drugs.
Okay, so if you compare European and US market, is now for German investors, is now the right time to invest in the US market?
Yeah, what's kind of nice about the US market right now is that we're in the process of a pretty significant repricing of real estate. And that's been driven not from the operational fundamentals, because the operating fundamentals for everything except for B and C class offices and maybe some B and C type of super regional malls, but the operating fundamentals are really strong, right? Vacancies in a lot of different asset classes are at record lows. Rental growth remains pretty strong kind of across the board, right? So we like the operating fundamentals that exist, but you're seeing this repricing, as a result of, basically interest rates rising. And what I'm hopeful is that, we may have seen sort of the terminal level of interest rate rises with this last 25 bip raise that's increased. And so maybe we can get a little bit of stability. And we haven't been able to really see a ton of price discovery because of the continuous interest rate rises and the uncertainty about how much higher are they going to go. But I think we're now at a point where I'm hopeful that we see that kind of flattening off. And so transaction volume may pick up at a repriced level.
But if you see, to take a look on the inflation rate in the US or on the other things, do you think there's a risk in the market, or is it now getting better to invest? If it's compared to for half a year ago. So.
Yeah, compared to half a year ago, I mean, I think we're definitely planning for something like a mild recession, right? So some of the risk that could exist in the market is basically going to be around the demand for real estate. And so, our vacancy is going to continue to remain low. Are we going to continue to be able to increase rents, right? I would say there's also more on the capital market side, right? It's when do interest rates start falling down, right? And the two are related a little bit, because if the economy remains bust and so the operational fundamentals remain strong, you're probably not going to see interest rates falling, and so the cap rates are going to continue to remain relatively high. So you've got that trade-off that's going on right now.
So if you speak here on the Investment Expo with investors, are they more interesting on which sector they are more interested on, affordable housing, or what do you think?
Yeah, there's a pretty, it's funny, a very, very diverse view on different types. So some investors are very interested in alternatives, right? They just view that as an up and coming, and by the way, the alternatives like we just talked about a second ago, different types of property types that are becoming institutionalized and that are relatively acyclical, right? So if we do go into some sort of a recessionary environment, they'll probably perform, pretty strongly, relatively speaking. But the main themes are alternatives, definitely a lot of interest in industrial, and but I think for the German investors that I've spoken to, housing of different varieties are definitely probably the number one interest levels.
So if you speak about the yields, how high are they in the US and the different sectors? If you compare it with the German yields, maybe in the affordable housing or commercial, I don't know.
Yeah, it's interesting when you talk about the different yields. So a lot of the alternative sectors, the yields are generally speaking higher than, let's say, the 4 main food groups, right? But we've seen a repricing already in industrial where things that maybe were, had a 3 handle on it are maybe now trading with a 5 handle on it. And there are some trades that are going on in industrial. So that's a place where I think price capitulation has happened, and you've seen a couple of deals, meaningful deals that have happened. There's just not a lot going on in the housing space, right? So, for example, we've got dry powder to invest into apartments, but when we're buying them, we're probably saying to ourselves, "Hey, I need to get something with a 5." The cap rate needs to be sort of a 5. Yeah. The seller is basically saying, "Hey, I need something with a 4." Yeah. And I'll say this too, right? So this is where that bid-ask spread exists. When we're reversed and we're the sellers, right? We're saying, "Oh no, it's got to have something with a 4 in there. Come on, these are great apartments." And the buyers are basically saying, "Hey, it's got to look like something with a 5." So that's what we're seeing on industrial and housing. Retail is an interesting place because retail, and I'm speaking broadly across all kinds of different retails, but generally speaking, retail has been not really loved since 2017 when the retail apocalypse happened, and any retailer that was susceptible to sales online really suffered a lot, and retail was hit. COVID comes along, that did no favors for retail, and so as a result, cap rates rose. And so what we're actually seeing are, if cap rates used to be sort of a 7, those are actually creeping down a little bit, right? So it's some interesting dynamics that are going on right now.
Shawn, thank you very much for joining us. Thank you for your time.
My pleasure. Absolutely.